1 week before this announcement, NextDC pulled a $500 million raising off the table. No explanation. No press release. Just gone. Then, 7 days later, the company returned, not with the same deal, but with double the size. $1 billion. Structured as a 100-year hybrid security, with a Canadian pension giant providing a binding backstop on the entire amount. That sequence matters more than the headline number. A company that cancels a raise at half the size and then doubles it within the same news cycle is not correcting a mistake. It is signaling that conditions shifted, and that the revised terms found a different class of buyer altogether. La Caisse de dépôt et placement du Québec, one of Canada's largest institutional investors, committed to cover any shortfall on the full billion. That backstop transforms the instrument from a market-dependent fundraise into a near-guaranteed close. The initial coupon is priced at 8.25%. The market read this correctly. NextDC shares rose 13.6% on the day, trading at $12.79. But the price move is the surface. The structure underneath it is the story. A 100-year maturity is not a financing term. It is a philosophical statement about asset life. Corporate bonds of this duration are vanishingly rare outside of utilities, sovereigns, and a handful of U.S. universities. The implicit argument is that the underlying asset will generate cash flows across a century, and that the issuer will exist long enough to service them. For a data center company, that argument requires a specific belief that compute demand, in some form, will persist for 100 years. Not the same workloads. Not the same hardware. But enough structured demand for physical infrastructure that the land, power, and cooling assets remain productive indefinitely. The instrument NextDC chose to issue hybrid securities sits between equity and debt on the capital structure. It counts as equity for accounting purposes, which means it does not mechanically increase the company's reported leverage. That distinction matters for credit ratings and debt covenant headroom, particularly as the company builds toward its contracted order book through FY29. This is the point most observers are treating as a footnote. The hybrid classification means NextDC can raise $1 billion without it registering as debt on its balance sheet. The implications for future raise capacity are not trivial. On the same day NextDC closed its hybrid, a separate Australian data center company called Firmus Technologies announced it had raised $505 million at a $5.5 billion valuation, ahead of a planned ASX IPO. Firmus is backed by Nvidia. The round was reportedly oversubscribed. At least one analyst described the $5.5 billion figure as already conservative, given the pace at which AI workload demand is moving. These two events arriving on the same day is not coincidence. It reflects where institutional capital is flowing in the Australian infrastructure market. But they are not the same bet. NextDC is a listed operator with physical assets, contracted revenue, and a defined pipeline to FY29. Firmus is a private company at a pre-IPO valuation, with Nvidia's balance sheet providing strategic credibility but no operational track record at scale. The Nvidia backing is the detail worth pausing on. When a chip manufacturer takes an equity stake in the infrastructure company that will consume its GPUs, it is not a passive investment. It is a supply chain alignment. Nvidia has an interest in Firmus succeeding precisely because success means more GPU deployments in Australian data centers. That dynamic changes how to read the $5.5 billion valuation. It is not purely a market price discovery exercise. It reflects what a motivated strategic investor is willing to validate, which is a different thing entirely. The constructive case for NextDC rests on a single condition, that the contracted forward order book through FY29 holds, and that capacity comes online without material cost overruns. If those conditions are met, the hybrid raise effectively pre-funds the construction pipeline with patient capital that does not pressure near-term earnings. The 8.25% coupon is the cost of that patience. The pressure case is more structural. Data center construction is capital-intensive and time-sensitive. Power procurement in Australian cities is increasingly constrained. If the gap between contracted demand and delivered capacity widens, whether through grid delays, construction inflation, or customer renegotiation, the 100-year instrument creates obligations that outlast the conditions that justified them. There is also a competitive dimension that is easy to underweight. Firmus entering the ASX market at a $5.5 billion valuation, with Nvidia's backing and an oversubscribed raise, means the Australian data center sector is moving from a single dominant listed player towards something more contested. That does not immediately erode NextDC's position. Contracts are long, and switching costs in co-location are high. But the pricing power dynamic that NextDC has enjoyed, as the primary listed vehicle for this sector exposure, is not permanent. Evidence points toward the constructive case holding, but only if power infrastructure keeps pace with the construction timeline, and only if the AI workload cycle does not inflect downward before FY29 assets are generating revenue. The recovery path, if construction delays materialize, runs through the hybrid structure itself. Because the capital is committed on a 100-year horizon, there is no near-term refinancing cliff. NextDC has time that a conventional bond issuer would not have. Australia is building data center infrastructure at a speed and scale that was not anticipated 3 years ago. 2 major capital events on a single day is not a trend. It is a threshold being crossed.